My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make money because my job is not just to entertain you, but it's also to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Query: what kind of self-destructive maniacs actually want long-term interest rates to go higher? How about the kind of maniacs who invest in the stock market? After a day where the Dow inched up 37 points, S&P dipped 0.07%, NASDAQ declined 0.22%, you got to remember that rising bond yields, like we got today and much of this past week, make investors feel more confident about the economy. When you see the yield on the benchmark 10-year Treasury moving higher, it makes you feel like we can avoid a recession. Positive. Regular viewers know I think all of these fears about a recession were really overblown. If anything, I think we've had a mild slowdown, but we could reaccelerate if the Federal Reserve keeps its strategy of cutting rates. All aboard! Why didn't I buy the argument of the recessionistas? Because their whole thesis was about the bond market itself. Remember that thing, the inverted yield curve, when long rates went below short rates? They told us that was an infallible sign of serious slowdown. But I thought it was a false tell. I told you that the bonds were a false tell. Treasury yields were tumbling not because we had a weaker economy, but because our rates are so much higher than the rest of the developed world. So you had tons of foreign money flooding our bond market, pushing prices up and yields down. Now the smoke is cleared and the markets feel more placid. That's why last night I warned you not to become complacent about stocks. I feel like investors are bidding up all sorts of stocks that really shouldn't be rallying at the same time. However, we had some today meaningful profit taking, notably in Apple, after a research firm cut its price target and its earnings estimates off of an accounting issue involving Apple's entertainment offering. Although Apple strenuously denied that estimates should come down like that. Apple kiboshed it. People didn't care. They kept selling the stock. Also, Broadcom, the semiconductor giant, got hit after reporting some slightly, let's say ever so slightly disappointing numbers. The stock lost 10 points to a level that I actually find interesting. But I admit I might be premature. More on that later when we play hostage, no hostage to China. All in all, though, I'm concerned about stocks here. I worry that this market won't be able to maintain its rosy hue, with the banks, the cyclicals, the transports, the soft goods all moving higher when we have a difficult Fed meeting staring us right in the face next Wednesday. But let's not get ahead of ourselves. Let's go back to our game plan. The game plan for next week starts on Monday, when we're likely to learn more about the much-lamented WeWork IPO. The forced nature of this underwriting has me a little spooked. The market can't seem to bear even a $15 billion valuation for a company that was valued at $40 billion. This whole WeWork deal makes me nervous. When you have an IPO that can't seem to find a price low enough to bring public, well, wait a second. Maybe you shouldn't bring it at all. I mean, if WeWork is that desperate, why the heck would anyone want to buy the stock other than to flip it, maybe? Now, does this stock have the power to knock down the whole market? That's the thing about broken IPOs. They do have a nasty habit of bleeding over to the rest of the market. I say let's see if they can even price the darn thing, maybe around $10 billion. That might be a level where this heavily indebted millstone won't drag down the averages. Given that there's some seriously positive revenue growth, maybe some people can stomach the losses at a low enough valuation. Maybe. Tuesday, after the close, we hear from two super important companies, FedEx and Adobe. The last time FedEx reported, management had some pretty negative things to say about trade, especially trade with China, because of the trade war. I think this company has a better handle on the global economy than the Federal Reserve or the Commerce Department or even the White House. I doubt things have gotten better since last quarter, not when you consider all these trade tensions. Then there's Adobe. It's a cloud king with a stock that's down about 11% from its high. That's a rare discount. I'm betting Adobe will deliver a strong quarter, as it's at the epicenter of digital commerce, and that's the most robust part of all technology. Speaking of robust tech, Zscaler, the cloud-based cybersecurity company, is having an analyst day. And boy, is this one ever important. Why? Because when Zscaler reported earlier this week, its CEO said that it's taking a little longer to close big deals. Wall Street interpreted that as meaning the company now has competitors impinging on its territory, and it caused the stock to get crushed, with the pin action actually devastating the entire group. Frankly, the whole cybersecurity cohort's been crumbling, including CrowdStrike, which I thought last night told us a great story of this very show. We also get some macro figures for industrial production and capacity utilization. I am hoping, at least for the bull's sake, that they'll be weaker than expected, because on Wednesday, Fed Chief Jay Powell gives us his latest monthly pronouncement, and he needs as many weak numbers as he can possibly muster if he's going to justify a rate cut, especially after the strong retail sales number we got today. I really don't envy Powell here. On the one hand, he's got the president calling him a bonehead for raising interest rates too quickly last year, which slowed the economy to stave off the phantom of non-existing inflation. Now, you know I felt that Powell did a bad job on this, but that's okay. I wouldn't call him a bonehead. Well, I kind of did, but now it's the president. He's got more of a bigger office than me. If Powell eases, he'll temporarily satisfy the president. But on the other hand, he'll also look like he's selling out the Fed, which is supposed to be independent, unless he has some less than robust numbers to back up the move. If Powell doesn't cut and President Trump throws up more tariffs against the Chinese, something that's still very, very possible, then the slowdown thesis becomes a lot more credible and palpable. Now, I know earnings reports will be on a sideshow on Wednesday because it's all about the Fed, but General Mills has been one of the hottest food stocks this year, and it's up an astounding 38%, and that's because of some terrific execution by CEO Jeff Harmening. Typically, this is not the kind of stock you buy when bond yields are flying higher as they were today. That said, if Powell decides not to cut, I think the recessionistas will be all over every media outlet they can find, predicting all sorts of doom and gloom. That's good for Mills. General Mills has a 3.6% yield. It has some real organic growth. You do a lot worse. Next up, Darden. Yeah, that's the parent of Cramer fave Olive Garden. It's been one of the best performers out there. Even hit a new all-time high today. You wouldn't get that move if the consumer were hunkered down, worried about a slowing economy. Like FedEx with World Trade, Darden gives you a great read on the state of the average American looking to order in, stay home, go out to dinner. I know I'll be listening. They do a lot of, they've been doing a lot of stuff with takeout that's very technological. Finally, while there are no earnings of note on Friday, I think we might be due for a trade update from the president. He's been prone to offer his views on Twitter about China in the afternoon. They've often left us puzzled, if not stunned, and I've come to dread the tweets about trade on Friday. All I can say is you've now been forewarned. Bottom line, we've had a monster good week. It's been a couple good weeks to the market, and it's been on a real roll. But I got to guard you against complacency here. We got a big, bad Fed reserve meeting looming next week. And if Jay Powell can't find a way to thread the needle between fealty to Fed orthodoxy and presidential pressure simultaneously, well, this market could have a very rough go of it next week. Let's go to Noor in Georgia. Noor.
Yes, thank you. Mr. Cramer, thanks for taking my call.
Of course.
This one's on Keurig Dr. Pepper. Current stock price. What's your take? Is it in line with where you think it deserves to be, or is it possible this thing may be a bit undervalued?
I like the stock. I like the stock very much. I think that Gam Gord is doing a terrific job. I would buy it on any weakness. It's one of my favorites, and not just because I like Diet Dr. Pepper, as everybody knows, on a late Friday afternoon. Sure, the market's been on a roll, but I want you to be. You got to guard against complacency here, people. Things may not go the bull's way on Wednesday. On Mad Money tonight, wondering which companies are controlled by the trade talks with China? Well, I'm going to play hostage, non-hostage. I'll run down the list. Then, Smile Direct sure didn't leave investors smiling after its first day of trading. Should you brace yourself for more pain ahead? I'm going to give you my take. And school's back and in session. You know what that means. Homework is due. I'll turn mine in tonight and let you know which companies are making the grade. Hey, there's a couple of bargains. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.